Financial planning spreadsheet. Financial planning spreadsheet is a tool often used by startup or small business to organize and project their finances. Each component represents a comprehensive financial plan. Let's look at it. The first one is startup cost. This is for everything you need to spend money on before your launch. Examples of startup cost could be equipment such as laptop, machinery, kitchen gear, legal, business registration, lawyer fees, document, branding, logo, website, business card, landing page, branding, marketing, pre-launch campaign, ads, distribution, word of mouth, spreading through ads, rent, office, warehouse, deposit furniture, license and permit, especially for manufacturing business and online businesses, startups. Why does it matters? It helps us to determine how much initial cost you need, and it lets us know how much money we will need for investment. It sets a realistic baseline for how much it will cost to just start, not operate yet. Cost of goods sold. Cost of goods sold is the direct cost of creating the product or service you're selling. If your physical product startup, it could be raw material, fabric, wood, ingredients, packaging, manufacturing, or assembly labor. If you are a tech startup, it could be hosting fees, third-party tools are needed to deliver the product. Um, it could be engineering cost, it could be cost of AWS or backend hosting fees. The formula for cost of goods sold is if the cost is 100 to make your product and you sell it for 300, cost of goods sold is 100 and gross margin is 300 minus 100 is equal to 100%. Why does it matters? High cost of goods sold is equal to lower profit margin. It is essential for pricing strategy. It is important for profitability, forecast, and unit economics. Sales forecast. In this, we estimate how much of our product and service we will sell in over time. It is typically broken down by months, quarter, or year. It is based on customer segment, channels, or product time. How to calculate the forecast? We estimate the number of units sold, we multiply by the price per unit, and we adjust for seasonality, growth rate, and market trends. Let us take an example. If we sold 100 units in January per price unit of 500, the revenue will be 50,000. And if we sold 150 units in February per price unit of 500, the revenue will be 75,000. Why does it matter? It is the backbone of our financial plan. It helps the production, market budget, and hiring. It is critical for cash flow prediction and investor confidence. A four component is salaries. We track our salaries per expenses, which are usually high, which is usually the largest cost in the startup. It includes the founder salaries, employees, marketing, product sales, admin, design, engineers. It contains contractors or freelancer. It contains payroll taxes, health benefits, bonuses. A typical setup is such as designer in we hire a designer in January and of monthly salary 80,000. The annual cost will be 9,60,000. And if we hire a marketer in March with monthly salary of 1 lakh, the annual cost will be 10 lakhs. Why does it matter? It helps us to calculate the monthly burn rate, how much we are spending each month. It is crucial for understanding when to raise a fund again. It helps us to plan team expansion in phases. Forecast of profit and loss statement. It is how much profit or loss we are making month by month. It includes revenue from the sales forecast, cost of goods sold, gross profit, which is revenue minus cost of goods sold, operating expenses such as salaries, rent, marketing, software tools, taxes, net profit or loss. Why does it matter? It helps us to determine if we and when your startup will be profitable. Investor use it to judge the health and viability of your business. It shows how much burning each month if you're not yet profitable. Break-even analysis. Break-even point is when the total revenue equals to total cost, no profit and no loss. At the break-even point is when we cross that point, it considers that break-even point. The formula for this is equal to break-even unit is equal to fixed cost by per price unit minus variable cost per unit. Example, the fixed cost is 1 lakh per month, selling price is 500, variable cost is 200. The break even will be 1 lakh divided by 500 minus 200, which is 334 unit. Why does it matter? It shows how many sales we need to survive. It is critical for pricing strategy. It has set us a realistic sales goal. The seventh component is funding. The funding shows us how much capital we need and how we will use it. Categories: seed, series A, grant, bootstrap, capital. Use of fund could be team, product, marketing, runway, engineering. Why does it matter? It shows the clear breakdown of our thought through expensive. It tells the investor how long the money will be last, the runway. It prepares the pitch deck for investors and meetings. Eight component is unit economics. It shows the profit per customer or product unit. It's about scalability. It shows the customer acquisition cost, how much it costs to acquire one paying customer, LTV value, customer lifetime value, how much one customer is worth over time, contribution margin revenue, variable per cost. Why does it matter? It proves that our business model is sustainable. It shows the investor to love strong unit economics. It helps to optimize for marketing, pricing, and retention.